Good evening, everyone. I welcome all of you onto this call by HDFC Mutual Fund. It would be fair to really understand as to how value strategies have panned out and what promise do they hold. And to understand this better, we have with us our fund manager, Mr. Anand Laddha, for our HDFC, who is the fund manager of our HDFC Value Fund. Anand has been with us for over 20 years and he has significant amount of experience in the banking and financial services space, especially as an analyst. And he has been the fund manager for our HDFC Value Fund since February 1st, 2024, when he took over as the fund manager of this fund. And he would be taking us through this fund and the value as a strategy in general and give us an understanding how it provides potential for potential investors. So Anand, over to you, and I'd like you to take over to this call.
Perfect. Thank you, Aditya. Good evening, good afternoon to everyone, and thanks for spending time with us. I'll cover this presentation in two parts. First, I'll talk about a little bit on the market, view on the market, how do we see the valuation of the market. Along with this, I'll speak a little bit on the BFSI sector, since I'm the analyst for the sector and also managing the business fund. And this has been a pretty long sector and a darling for every mutual fund, for every investor. So I'll speak on the BFSI sector as well. And in the second part of the portfolio of the presentation, I'll cover what is value fund, how we are managing the value fund, and how we are defining the value in the portfolio. So if you if you generally look at 8%, FY 27, 28 will be move back to our normalized rate of 14 to 15% on the Nifty side. In general, our markets are little expensive when we look at historical number. And that is for a reason being the fact that we continue to see a very strong inflows on a domestic side. The equity cult in the country has come back, and in general, therefore we remain a little expensive market. But if you say expensive, but if you compare, look at the interest rate in the economy, in that context, our markets are not expensive. If you look at the 1 year deposit rate today, it's at 6.5%, or you take out a 10-year GSEC rate, it's at around 6.5%. If you remove the tax on the same, then the return on the fixed income is 4.5%. In that context, our market still offers a lot of value. And within large cap, mid cap, and small cap, large cap is fairly valued. You can see a lot of upside. In fact, large but cheaper than the mid cap stocks. Mid cap space, which is very richly valued, and for a reason, because in the mid cap space we have a lot of concept stocks which are coming up, right from fintech companies to newer companies which are coming, and they are very richly valued. And therefore, mid cap in general has a very high value. It's a very high P multiple. And within small cap universe is very large. And therefore, while some pockets of small cap are expensive, some are reasonably valued. So you can find value in small caps. You can find a lot of value in large cap. Mid cap remains a play on relative valuation. You look at the relative valuation of the sector, of the company, of the historical and you play the mid cap story through that. And second important thing, in last 4 years, if you see FY 23 to FY 26, we are talking about almost 270 new company got listed in the main board. This is not SME board, I'm talking main board. And the raise close to what 4 lakh crore. So all these 270 company are decent quality companies. So India as a market is getting discovered, and more company are getting listed. Most of these company are getting listed either in the mid cap space or in the large cap space, in the mid cap space or in the small cap space. And therefore, as more and more company get listed, you will find in general the PE will keep on getting down. To give an example, long back when HDFC AMC was listed, we were the only listed entity. Today, as I speak, there are 6 more AMC listed, and SBI in the quarterly call said that they are looking to list even SBI AMC. So post that we'll have 7 AMC listed. And when so many players get listed, in general, valuation premium keeps coming down. So overall, to say our markets, if I had to conclude, Our markets in large cap are reasonably valued. You can see a lot of value in large cap. Mid cap expensive. You have to look at only relative valuation. Small cap universe is very big. So from here on, I think everyone should focus on any volatility, any correction in the market would be a good time to increase allocation to equities. That was my view on markets as well as BFSI space. I'll now speak a little more on the value fund. See, this is a very old fund of ours, more than a 15 years of track record for this fund. In each time period, different fund managers have managed this fund despite different style. I got this fund 2 year back, and post that period, I've been changing the portfolio composition, and almost all the changes has been done. Today, if you go back 2 year back when I got a fund and you see the portfolio composition now, there has been almost like a 50% stock has been changed. Now the question everyone will ask, what is value? How it is different from so many categories in the market: flexi cap, large and mid cap, small cap, multi cap, large, multi. So value at our end or our scheme information documents define value as 60% of the portfolio will be comprising of companies such that where the trailing PE or price to book value will be lower than the last 5 year average PE or price to book value, which means 60% of the portfolio will be such that would have a lower value than the last 5 year average. And that is what we had defined value in the scheme information documents. 40% of the portfolio can be anything, which means even we can buy highly richly valued stock because that will be part of the 40% of the portfolio. So the advantage the fund has, if I buy some stock which are today value as per a definition, and because of stock appreciation, price appreciation, they get into a rich valuation, I can still own those stock in the portfolio because they will be categorized as 40% of the in the 40% portfolio. So today, as I speak, uh, we look at the definition every month and look at the portfolio. And today, as I speak, almost 83% of the portfolio qualifies as value, which means 83% of the portfolio is such where the PE or price to book value is lower than the last 5 year average. Uh, that is what is the value defined by us in the scheme document. How do I look at opportunity in the sector? This fund is benchmarked to CNX 500. So for my benchmark is very wide. And how do I look at different companies, different sectors in uh, how do I look at companies? How do I identify ideas in the fund? I look at ideas broadly into three categories. One, absolute values. Second, turnaround companies. Third, relative valuation. As I speak, I'll give lot more example. What are the companies? How do I define absolute value? How do we define turnaround companies? How do we define relative valuations? Based on this, we invest and so what are so as we speak, if you see the portfolio constraint, today as we speak, 20% of the portfolio is absolute value. And by absolute value, what we mean? See, there are companies, there are sectors where we feel ki they are trading at very close to their intrinsic value. There is nothing to lose in these companies. These are companies which are mature companies or mature sector where the growth will be limited, but valuation factors in everything. Some of the example of absolute value could be what? Could be refinery companies, could be petrochemical companies, could be some of the utilities companies, some of the gas transmission companies. All these companies are mature businesses where businesses will be growing closer to nominal GDP number. Sorry, real GDP number, which means this businesses will be growing at 6 to 7%, fairly high cash rich company, cash flow generating, and profitable companies. Since the growth is limited, that's why they are trading at a particular multiple. These are the one which where we see limited downside. We see they are very absolute value. They are trading closer to intrinsic value or below intrinsic value. This is 20% of the portfolio. Then we have relative companies. What is relative valuation? See, today we speak when you look at different sector in the market. Uh, if you look at IT companies or FMCG companies, they both are either contra and are trading below relative valuations. So while FMCG companies all trades at 40p, 45p multiple forward, but if you look at relative to the history of where they were trading, they are trading at relatively cheaper. Second, this today are completely contra trades. These are relative valuation and a contra trade. Uh, there are last 3 years, if you look at FMCG companies, returns has been negative, or they had not given enough return where they are given return lower than the benchmark returns because of the GST effect. I think we are at an inflection point where not only the volume growth will increase, even the pricing growth will come, the margin will come. There has been a lot of tailwind because of the inflation. Inflation is coming down. So most of the FMCG company today are trading at a relatively cheaper valuation to the historical multiple, and therefore they become part of our relative valuations. Not only you will get earning growth in these companies, you will get some valuation re-rating also in these companies. Second, IT companies. Today, India is an anti-AI trade. World over, people only talks about AI and impacts. Therefore, all our IT companies are trading at last below last 5 year average multiples. Th- All the IT companies today are still cash flow generating company, trading at 4 to 5% dividend yield company, and most of the negatives today are in factored in. If there is any positive, or if the AI market gets a feeler that the AI will not be as impactful or the AI bubble burst, I think IT would be a direct play on that. Would be the Indian IT will be the biggest beneficiary of that. Today, almost all the IT companies are trading below historical averages as well as offering good dividend yield. And this is how we defined the relative valuation companies. There could be some pharma company in that which are a play on the CDMO sector, and they are trading at relative valuation cheaper than the historical valuation. And lastly comes the turnaround companies. uh, Generally, how we define turnaround companies as whenever see business at inflection point. Inflection point means wherever the cycle is changing, or the profit margins which have been suppressed in the past are likely to go back to normalized level, or like in banking we said asset quality turning around would be a inflection point in the businesses. Sometimes capital allocation is getting right, sometimes large capex has happened, now earning visibility will improve, or that capex will start earning. All these examples are defined into a companies, we call them as into turnaround phase. Turnaround means simple business at inflection point. What are the companies, or how many companies are there in the portfolio, sectors are there in the portfolio which are into turnaround phase? If you look at, we bought Rajasthan based small finance bank when they had asset quality challenge in the MFI side. We bought a south based NBFC which is into a smaller ticket lab segment, which also got impacted because of the sentiment around microfinance got impacted. I got large bank which are seeing challenges on the deposit side, and are now seeing which are seeing challenges on the deposit as well as NPA side, now are seeing both the challenges getting mitigated, deposit as well as NPA. Life insurance companies which have been impacted because of the regulatory, they are part of the turnaround phase. Lot of retail companies, retailers like value retailers, electronic retailers, uh, they're all impacted because of the consumer sentiment down. Now with growth improving, there is a very strong belief that the margin will improve, and therefore these all are categorized into a turnaround company. I also own a small Kolkata based electric company. It is a value company because its price to book value is lower than all the electricity generation company. They are also now going back into capex mode. They are deploying all their cash flows into capex, and therefore earning growth from here on will improve. And this is how we define turnaround companies. So to give context in terms of how do we look at returns, see, generally absolute value companies give you compounding returns, uh, compounding return in line with the earning growth. Companies which are relative valuation, there the thought is they are trading below relative valuation. From here on, the earning growth will come along with the valuation re-rating. They'll go back to either historical valuation or will trade at premium to historical valuation. And therefore, overall, we believe the portfolio we are when we construct, we generally take a 3 year view. See, historically, the portfolio has given 20-25% return, but I think we are as a country or as a market, we are into a phase that most of the ideas in our market are discovered, and therefore we are constructing. See, one In the query, one can ask why turnaround companies are at 36% of the portfolio. No, why not 50% of the portfolio? Why not 20% of the portfolio? End of the day, you have to all look at how do you manage the portfolio risk. See, when we look at turnaround company, we expect keep maybe in a 2 quarter, maybe in a 4 quarter, you will see turnaround visible, and therefore valuation re-rating will happen. There can be time when there could be a false start, and therefore to manage the portfolio risk in generally we will turnaround company should be closer to 40% of the portfolio, which will not only provide alpha but also will provide to the portfolio, but also will not increase the risk in the portfolio. So these are the sectoral allocation in the portfolio. I continue to remain overweight on financial, real estate, utilities, healthcare, a little bit underweight on materials, industrial, energy. And in terms of portfolio split, it is still large cap heavy. 70% is large cap, 30% is mid and small cap. This has been the performance of the fund. And if you look at the rolling return of the performance of the fund, so if you look at 1 year, we are able to beat the benchmark. 3 year, we are able to beat the benchmark. 5 and inception, the fund has been able to beat the benchmark. And if you look at the rolling return of the portfolio, the 2 year rolling return when I took out the portfolio, if you look at a bulk of the instances, maybe probably 80 to 90% of the instances, we have been able to beat the benchmark. Even on the 5 year rolling period, bulk of the time, the fund has been able to beat the benchmark. These are some of the holdings of the portfolio.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.